Welcome to the Explainer. Okay, let's just dive right into one of the absolute most fascinating paradoxes in the investing world. Today, we're looking at the biotech sector, and we're specifically viewing it through the lens of Viridian Therapeutics as they navigate what is going to be a make-or-break 2026. If you've ever found yourself wondering how on earth financial markets can value companies that are literally burning through hundreds of millions of dollars while trying to cure severe diseases, well, you're in the right place, because this is the perfect case study.
Right off the bat, there's this glaring financial disconnect. At the end of 2025 and heading into 2026, Viridian Therapeutics brought in exactly $0 in commercial product revenue. Nothing. Zip. And yet, Wall Street looks at this company and slaps a market cap of nearly $2 billion on it. To anyone outside the biotech bubble, that sounds completely irrational, right? But in this sector, you aren't paying for what a company sold yesterday. You're paying for the probability of what their pipeline is gonna sell tomorrow.
And getting to that tomorrow? Yeah, it is incredibly expensive. In 2025 alone, Viridian posted a staggering net loss of $343 million. That number brilliantly illustrates the sheer scale of the cash burn required when you're running multiple global phase 3 clinical trials all at once. They're pouring vast amounts of money into research, development, and gearing up for a commercial launch of a drug that hasn't even been approved yet.
Now, how do you actually sustain that kind of massive cash burn without going under? You need a gigantic safety net. You simply can't burn $343 million a year without a very heavy bank account. Luckily for investors, Viridian wrapped up 2025 sitting on an $875 million mountain of cash equivalents, and short-term investments. They actively went out and raised capital, including a major stock offering, just to build this war chest. It is the absolute lifeblood keeping those clinical trials moving and the lights on while they wait for the FDA's green light.
Moving on to Section 1, the science. Targeting thyroid eye disease.
Let's ground all those crazy financial numbers in clinical reality for a second. Why exactly are they spending nearly $1 billion? Well, it really comes down to treating a severe, frankly, debilitating condition called thyroid eye disease, or TED. As you can see, the physical presentation of TED is severe. It's an autoimmune disease that causes all this inflammation and tissue expansion right behind the eye. Patients are dealing with bulging eyes, double vision, incredible pain. It completely alters how someone looks and totally derails their quality of life. This right here, this is the human impact Viridian is trying to fix.
So the really crucial point here is their solution to this. Viridian has engineered two primary drug candidates that target a specific receptor called IGF-1R. The first one is veligrotug, which is given intravenously. And the second is elegrobart, which is super interesting because it's designed as a low-volume subcutaneous injection, meaning it's just a shot right under the skin, which could be a massive, massive convenience advantage for patients compared to sitting for hours getting traditional IV infusions.
All right, Section 2, the pipeline. Mapping 2026.
So the science is set, the trials are running at full speed, and 2026 is the year where all these massive investments finally come to a head. In Q1 and Q2, we are expecting the top-line data from their phase 3 reveal trials for elegrobart, covering both active and chronic TED. Then later in the year, we're going to see data for yet another candidate, VRDN 008. But nestled right there in the middle of the year is honestly the most critical event of all.
June 30th, 2026. Seriously, grab a pen and circle this date. This is the FDA's PDUFA target action date for veligrotug. If you aren't familiar, PDUFA is basically the strict deadline for the FDA to either approve or reject the drug. Viridian actually submitted their application right in the middle of a US government shutdown, managed to secure priority review, and now literally everything hinges on this summer date. It's the ultimate watershed moment that could kick off their very first commercial launch. Let's look at Section 3, the balance sheet.
The fuel.
With those giant milestones staring us down, we have to objectively look at how management is fueling this super aggressive pipeline. And there's a really compelling story of scale here. Look at how research and development expenses just ballooned, from $160 million back in 2023 all the way up to $339 million in 2025. And because of that, the net loss obviously widened year over year. Now, in a normal tech or retail company, widening losses like that are a massive red flag. Run for the hills, right? But here, rising R&D means those phase 3 trials are fully enrolled and actively running. This huge expense is actually the evidence of their clinical progress.
And if we zoom in on just the most recent quarterly data, you can clearly see those consistent elevated operating expenses. They are routinely spending well over $100 million every single quarter. Q1 of 2026 alone hit $116 million in operating expenses.
This intensely high burn rate is exactly why having that massive $875 million cash cushion we talked about earlier is so vital while they're sitting in the waiting room for the FDA's decision. So, the big question, how far does that money actually go? Well, based on their corporate presentations, that $875 million balance at the end of 2025 gives them a really thick runway. Plus, if veligrotug does get that FDA approval, they're anticipating a $75 million milestone payment right away. Management has been explicitly clear that they expect this combo, the cash on hand, potential milestones, and eventual commercial revenues, to fully fund their business plans all the way through to actual profitability.
Which brings us to our final part, Section 4, Wall Street's verdict.
So we've got the science, we've got the severe cash burn, and we know the upcoming catalysts. How are financial analysts weighing this incredible risk against the potential market reward? Well, despite the fact that they have zero current revenue, the consensus is overwhelmingly positive. Analysts currently rate this stock a strong buy. The average price target is sitting right around $31, and when you compare that to a recent trading price of about $17.90, you're looking at a massive potential upside of over 73%. Analysts clearly believe the clinical data we've seen so far totally validates the pipeline.
And if we look a little further out, the forecast models are finally showing that light at the end of the tunnel. While 2026 is, for sure, still going to feature severe losses, which is totally understandable as they fund a massive commercial launch, analysts project that by 2028, Viridian could finally cross the line into positive earnings territory. They're estimating around $6 million in net earnings if both of their lead drugs successfully hit the market.
Which leaves us with the ultimate question as we wrap up this explainer. Will Viridian's cash runway successfully bridge the gap to actual commercial profitability? I mean, they've got the science, they've got the cash, and those critical FDA dates are completely locked in for 2026. It is a textbook, high-stakes biotech play, and we are absolutely going to be watching closely as that June 30th deadline approaches. Thanks so much for joining me on this deep dive.